Welcome to the Law, Your Money, and You. I'm Roberta Sapphire, an attorney in Sharon.
And I'm Camille Barron, a healthcare advisor and financial organizer, also in Sharon.
Massachusetts,
New England,
USA,
world.
Yay.
Okay,
And we're very fortunate.
we're very fortunate today because we're going to be learning a lot about some of the hidden tax implications of a lot of decisions that people have to make.
Yeah, and we are so lucky, and that's why I said USA, because we have with us CPA Alan Lury, who's been on the show before and is one of the people who helped us bring financial literacy into this area.
Certainly.
Welcome.
Thank you. Thank you very much.
So we're going to talk today
Yes.
about some different considerations, I guess we'll say,
Yeah.
regarding decisions that you wouldn't immediately think of that have tax implications, some of them retirement decisions, etc.
Right.
But we think people need to know about them because it's definitely a very important part of those decisions.
It is. I receive almost on a daily basis from different online subscriptions that I receive, whether, the list of the 10 best places to retire, the 10 worst places to retire, and the reasons why. And a lot of them, of course, everyone wants to retire to where it's warm and it doesn't rain and it doesn't snow. But unfortunately, there's other factors involved that people have to take into consideration, and taxes being one of them, estate taxes another, and taxability of pensions. So it's quite interesting how from state to state, especially, for instance, state of New Jersey, if you receive a federal pension in the state of New Jersey, that's taxable. And unlike Massachusetts, where it is not, so it has an effect of where you're going to want to live, and the cost of living, of course, is another factor here, where we have high property taxes, and it's difficult. Earlier today, I was talking with a couple of an attorney and actually another financial planner regarding an issue that issues that he sees in his practice, and he specializes in working with widows. And what he sees quite often is the fact that because of the cost of living, high taxes in the state of Massachusetts, it's very difficult, especially when they become a widow and they lose half of their Social Security, to maintain their family home. Even though they want to maintain the home, they literally, it becomes a significant burden. And
Is Social Security taxable too?
well, yes, Social Security, if you have unearned income or still working, it could be potentially taxable up to 85%. So that's a critical factor. Now, some states, luckily Massachusetts is one of them, Social Security is not taxable.
But with federal
With
government,
federal,
it's
it is taxable. In Rhode Island, if you earn above $100,000, your Social Security becomes taxable. So it's interesting. Every state has a different rule as far as the taxability of Social Security.
When you said a couple of minutes ago, if you're receiving federal pension, did you mean Social Security or something else?
No, I mean like a federal pension. I had been talking a couple of weeks ago with someone who's retiring in New Jersey from the FAA, and they said, well, I'm moving to Florida. And the reason, of course, they're moving to Florida is because their pension will not be taxable in Florida. Their Social Security won't be taxable, and there is no state income tax, and there's no estate tax. So,
Wow.
that's why people continue to flock to Florida because of that.
Is Texas like that too?
Yeah, Texas is one of the. Texas has no estate tax, as well as it has no income tax. In fact, I'm working. In the last couple of years, I've been working on an estate in Texas, and though interesting enough that there hasn't been any estate tax issues with the state of Texas, because the person was a Texas resident.
Wait,
Yeah.
now what if they live in Texas but their job is they get paid from a company that's based here?
Yeah, I mean, it depends where you live. That's why, it's well known that people who you see up here during the summer driving around at Florida plates, that perks up the eyes of the state of Massachusetts Department of Revenue, because literally they track people to see how many days that they are in the state of Massachusetts. Because once you get above 106 months, 181 days, that it means you are a full-time Massachusetts resident, and they're going to attempt to tax you. So that's a very important thing that this time of the year when people leave Florida because it's too hot.
What about if the company is in Massachusetts? Going back to the question, the company's in Massachusetts or wherever, and they live in Texas, but they're paid. Their earnings are from here. Don't they have to pay?
If they live where? If they live in Texas?
Yeah.
Basically, yes. They would have to file in that situation, which that could occur. Would be if they're living in Texas and they're working for a Massachusetts company. Again, it depends where they're the company actually would be filing payroll taxes in Texas. So it wouldn't be filing. It depends where the person is physically located. So, for instance, we'll make an easier example. Let's say someone lives in Rhode Island and they work in Mass. Because those states are right next to each other and all part of a New England tax compact, what happens is they'll have Massachusetts, even though they're working in Mass, living in Rhode Island, they would have Mass taxes withheld. They'd file a non-resident return in Massachusetts, get credit for that on their Massachusetts return. I'm sorry, on their Rhode Island return for the taxes that they pay to Massachusetts. So that's how that would happen. When you have situations where, let's say, a salesperson's living in and working in Texas for a Massachusetts company, they're getting a W-2 that's Texas, but Texas has no state withholding taxes.
So Massachusetts won't get anything.
They wouldn't get They wouldn't get anything because that person's in Texas.
I was working with a client last week. This is a healthcare client, but the client is a U.S. citizen, has been working for a company that's U.S. based, but is a permanent resident in Mexico.
Mexico, yeah.
So how would that work?
So they were U.S. citizen. Okay. So I've been spending a lot of time. This is a very hot button in taxation right now. Is that the person? Once you're a U.S. citizen under the U.S. tax law, and the U.S. is stressing this over the last 5 years more and more, you have to file all of your taxes as worldwide income for the United States. However, if you're living in Mexico, you're a U.S. citizen. When you file your return, that income up to approximately $105,000 is excluded from U.S. taxes. So it's a benefit of being an expatriate, an expat. So effectively, they're filing U.S. taxes for their worldwide income. But the fact is that if they're living and working in Mexico, and they're getting paid there, in the first $105,000 of that income, that's going to be excluded from their U.S. taxes.
There's no earned income because this fellow was retired?
Yes.
So he doesn't have any earned income from working?
Right. So.
Well, can he still get Social Security from the United States?
He can still get Social Security. The issue is that he effectively will get a tax credit in that case where there isn't earned income. That he'd get a tax credit on his U.S. return for the taxes that he pays in Mexico. But the whole idea is, there's a lot. Additionally, because he is living as a U.S. citizen who's living abroad, he has to file annually if he has more than $10,000 in any bank account, let's say in Mexico or anywhere. He has to outline that online. There's an online filing that has to be done now annually, and there's significant penalties for not filing that. And there's another form that has to be filed with the U.S. tax return, which includes details of all of the investments that he has overseas as well. So the government is clamping down and wants to get, they want their share of the earnings, dividends, interest that are earned overseas reported on the U.S. returns.
We know this couple in Nova Scotia that had dual citizenship.
Yes.
And they gave up the United States one because
Yeah.
they didn't want to pay taxes.
Taxes, yes, that is true. I'm working on a case just yesterday, dual citizenship in Ireland, and that's and they've sort of done some good tax planning in that they have kept their assets, their significant
Boy.
assets in the United States, and they've limited assets in Ireland, so that they're really not going to get taxed in Ireland. They're really still just going to be taxed primarily on their U.S. holdings.
You know, the tax implications people don't always realize are also an issue in healthcare, particularly with Medicare, because if you earn a certain amount over and above a threshold,
Right.
You get, in addition to paying for your Medicare Part B premium, which the standard one is $135.50 a month, you pay an extra amount, and it's called the IRMA, Income Related Monthly Adjustment Amount.
I think I heard of
And the issue with taxes, determining how much you have to pay, is they use not your adjusted gross income, your modified adjusted
Just
gross
gross
income.
income, right.
And that includes, even though, say, if you have tax deferred or tax exempt investments,
Right, it
so you
adds
don't
it
have it
back.
as taxable income or the AGI,
Right.
it would be considered for those purposes.
that's
Is that
correct.
how you've seen it
Yeah,
work?
I've seen it. I actually have some clients who have been subject to that, and it adds up to a significant amount
yes.
of money that they are charged for their Medicare premiums, and it is very significant. But again, it's used as a subsidy for the people, which is probably the vast majority of people who don't have very little retirement income. So it's unfortunately that people are being taxed from one hand to support the the Medicare system, which is like Social Security is going broke, and this is one of the stopgap measures that they put in place in order to keep it afloat.
So people on Social Security disability that never worked. They
Yeah,
get
they
it made.
unfortunately they never work, but I mean they have Social Security. One of the other big things, of course, right now the federal estate tax threshold is $10 million. So
went up.
basically, it's actually more than 10. It's inflation adjusted now, so it's above 10 million.
You're set.
And the issue is that probably 95% of the people are set from federal, but that doesn't make them exempt from state. And it's interesting, Massachusetts has one of the more egregious state taxes in that you don't get taxed if you have an estate under $1 million, okay? However, if you have an estate over $1 million in Massachusetts, you get taxed that full $1,001. It's not like the first million is exempt. They claw back every dollar, and so
Is there
everything.
a certain percentage? on that?
Yeah, then
Is
there's
that
there's a
5?
graduated rate that you're paying, a tax rate that you're paying on the actual estate.
So that's your topic in a way.
Yeah, a little bit. That's
where
one
you
of
going to
the
live when you retire?
right,
Unless you
and all of
spend it
these
all.
things. So for instance, Massachusetts is not a great place to retire if you're going to have a large estate, because of the fact that you're going to get hit if all it takes is $1 million estate, which today doesn't take that much considering the value of real estate. And so that's why people want to move out of Massachusetts as they get older, because of the fact that they move to Florida or other states, Texas, where there are no estate taxes. Even Rhode Island has modified their estate tax to where they truly don't look at, I think it's the first 1.6 million is totally exempt, and then above that there's a tax. So, there really should be some reform here in Massachusetts if we want to retain older
Alan, do you
people.
have the list of states that we should consider moving to?
Well, I mean,
How many are there with no
There's about
state
10.
tax?
There's
Really?
usually top 10 to move, and some of them are very interesting. I mean, you'll find places that from a tax
Taking
standpoint are might be attractive, but you won't find it very attractive from a weather standpoint. Like the Dakotas are some of the top areas from overall cost of living, taxation, places to live. So it's a lot of times it's the the areas that might not be attractive weather-wise, but they do have other attributes.
What about Arizona?
Yeah, I think
there's
Arizona's
Arizona.
probably has always been, I think that, not quite familiar with Arizona, but I mean, that is a big, that has a better tax structure than, let's say, Massachusetts. And of course, you have the weather is beneficial
Well, you
as
know what
well.
Arizona has too? If you donate to schools, I think, or charities, I think it's the schools, you can take that as a credit off your taxes. Not a deduction, but a
Deduction,
credit.
actually a tax credit. Yeah.
You get a tax credit.
No, that's that's interesting as well. So, it really, when people think about where the next step or where next the move, and a lot of times, they think they want to travel to be closer to their children. If their children have moved out of state, they really have to sort of take a look at all these factors that are going to affect them from a standpoint of their cost of living wherever they choose to move. Of course, here in the East Coast, West Coast, real estate being so high that that's number one factor as far as the cost of living, but then also taxation and medical costs as well, and also the availability of good medical services. I think one of the primary reasons why more people do not move out of Massachusetts is because Massachusetts is a hub of tremendous medical care, and that's what people stay here, is that that's part of the consideration. And why Massachusetts is not at the bottom of the list is because it does offer that benefit.
We have a number of clients, getting back to health insurance, that they live out of state, but they want to make sure that they can access health care in Boston
Right.
if anything
You
changes.
used
Right.
to say we're the medical and educational center of, cultural center of the world. We
Right.
have friends from Arizona that come here to the Mass General. You find a lot of people.
People travel all over the world to go to
Yeah.
the hospitals in Massachusetts. I mean, I've been in, some of I've been as a patient, and you sit around and you're just amazed by people who've traveled all over the world to,
Yeah.
to get services here. And you'd never think it, but the issue being that this is the place to go, and we take it
Yeah.
for granted. I think that's the biggest thing. We take it for granted.
Yes.
It's fascinating.
What else can you tell us about tax implications of decisions that people make?
Sure. Again, getting back to Social Security and your state pension, the taxability of that is critical, because you really want to be in a location that you're going to get the most cash as possible in your pocket, and having to pay a tax on your your pension, private pension or state pension, is going to have an impact on your standard of living. So it's important for people to check out these states, and the information is very easy to pretty much Google online. Is the best place, worst place to live in retirement, and to get an idea of what what there is. Some people might sit and think for years about, I want to retire to this place, this particular state, and then they find out that it's going to cost them a lot more than another alternative. So
Now, you said earlier, I think, you said the Social Security pension benefits are taxable at the federal level.
yes,
And
yeah,
but
you're
not
right, up
necessarily-
to 80, up to 85%. Yes, that's correct. Yes.
So how would that work if somebody has?
Yeah, I mean the
more
fact
than
if you have if you have unearned income or part-time job or whatever it might be, it's a graduated rate, so that as you get to a certain point, some of your Social Security becomes taxable, and then eventually, if you have a significant amount of unearned income, you're going to land up, receiving your Social Security, but 85% of it will be included in your calculation of your taxable
see.
income.
Okay.
That's how it
And
works.
depending on the state, it may or may not be at the state
Yes, it
level.
might not.
Okay.
It might be none of it. Might be like Massachusetts. It's not going to be taxable at all.
What if you put all your money in trusts
Well, you
so
put
that
your money
you
in.
never die?
You never die. Well, I mean,
The
the trust.
trust
The
never
problem is
dies.
with trusts is that you have investments in trusts. Trust tax rates are much higher than individual rates, and they ramp up quite faster than individual rates. So what happens is that you can be making to $50,000 in a trust, and you're paying a much higher level of taxation than if you were taking that same income and having it taxed at the individual rate.
Why would that be?
It's just the way the government has set up the trust to be taxed that way, because they view it as, I think they view it as a way for the government to get their share from people who can pay more money. I mean,
But aren't
it's
there
really.
certain trusts that are just what they call simple nominee, that you're holding it in trust, like you have a bank account in trust?
Right. Yeah. I mean, that's different, because I mean you have two types of trust. You can have a trust that's going to be taxed at the trust level where you pay the higher rate, or you can have the trust with the beneficiary, so that it's basically a pass-through trust where the beneficiary of the trust receives a K-1, and then it gets taxed at their rate, at the individual's rate. So there are a couple of different ways, but sometimes it's a situation where the intent of the trust is that is for the trust to grow and the beneficiary not to effectively have to pay any taxes on the earnings, so that everything in the trust stays within the trust.
You need a good estate attorney and accountant.
You do?
Yeah, you do.
But-
I mean,
but,
it's very important.
A lot of mistakes that people make is they think they can go on something like LegalZoom, which is okay to give you an idea, but
Yeah.
you can't just pull those forms down.
No.
Because there are certain
I
requirements.
mean, there's a lot of proper planning, and it comes down to everything, especially when it comes to estate planning, is that you have to have it laid out in such a manner that there won't be any surprises down the road. And unfortunately, most people don't plan. I have a client who, whose health is failing. His wife had recently passed away, and now the question is, how do we, protect, his home and his assets? So we sort of, triage to, put a plan in place to, start the process to protect his assets. Hopefully, he'll be able to protect as much as possible. But if he had sat down, 10 years before and went through that process even with the same estate planning attorney, it would be in a much better off position today.
You mentioned about retirement and decisions people have to make, and one of the things that people often do at that time, they may sell their home, etc., but they make a lot of financial decisions, investment decisions. Can you talk a little bit about how they can invest, or some of the ways that they can invest to reduce their taxes, things like capital gains taxes if they sell the house?
I mean, the whole idea, one of the good things is that when people, especially if someone's held their house for a long period of time, and it's a husband and wife, and they've been, they now want to move out of the family home. At this point, let's say in Massachusetts, they can exclude up to $500,000 on the sale of their primary home, based upon the basis of the house versus the selling price, the first $500,000 gain. So
Is that if you've lived in it for 2 years? Or
yeah, there are rules, but we're talking about someone who's lived in
You're
the
not
house
kidding,
for
because you've got to be kidding.
Is it,
Are you kidding?
is it only something they can do once, or can they do it?
No, under the rules now, you can do it more than once. It used to be a one-time lifetime exclusion, but now it's a multiple, and people take advantage of it. But the whole idea is now that people are receiving that money, but unfortunately, they are faced with a situation where, if they're going to move into a condo to downsize, that's great, and then they, take the the other proceeds, and really, that money needs to be invested. If all their assets were basically from the sale of their home, it needs to be conservatively invested in a way that it's going to generate to augment their Social Security benefits they receive and any other type of pension they might receive, to augment their budget. And really, people, when they get older, it becomes even more important to have a budget. People talk about, young people don't know where their money goes, but even when you get older, as your cash flow sort of decreases, you don't know where it went. And so that's why budgeting is an important tool that you need to start with early in your working career, so that you can manage your funds, so that you're putting your money away for retirement, you're putting away money to purchase that first home, to put away other investments, so that when it comes time to retire, you're in a situation where you're not going to worry about, how am I going to afford, to maintain my home, or even sell my home and maintain the lifestyle that I expected to have when I retired.
Are there financial professionals who help people with budgeting per se?
Yeah,
a lot of the advisors are more interested in investments.
Yeah, I mean, there are people out there. Have sat down with people and tried to get them to do that. It's a very difficult thing for people to acknowledge, to sit down with even in front of a computer or paper and pencil. And you
don't know where the years go, where the time goes, or where the money goes.
Exactly. So a lot of it, I have clients today, though, who are making a very concerted effort to make contributions into retirement plans for their college-age children, so that they're saying to them that I'll pay you on my payroll for $6,000, and all that money's going to go into an IRA, and or a Roth, and that's great, because if they're 20 years old and they're going to retire when they're 70, that $5,000 is going to grow for 50 years.
Well, isn't that that's for another time?
Yeah.
And there's so many. You've got to be kiddings along the way. I'll give you a you've got to be kidding. Our first house we paid $12,000 for.
That's a really, you gotta be kidding.
I used to say we overpaid by 10. But I mean, it's interesting. And back then, people were making just a few dollars an hour, and if somebody died, this is a good, you got to be kidding. The government gave you, I think it was $250 or something.
Well, they still did give you $250.
Yeah,
$255 to be exact.
Yeah, and it's still the exact same today.
Yes, it
and
is.
On that, I think that's a wrap.
I think it is.
Yeah. Thank you so much.
You're
You're always informative. It's always a pleasure, because we test you.
So far you've passed.
Yeah, you always pass. You always pass.
Thank
People who say they watch the show, boy, he really knows what he's talking about. I go, you bet, he really does.
Yeah, I agree. I think, like I said, you're a walking encyclopedia.
Oh, thanks.
Yeah.
So I want to thank our viewers for watching, and Alan, he's a great resource.
Yeah.
It's totally a great resource for all of us. And if you have any questions, please send us an email, and we'll be sure to forward it over to Alan if you are interested in more information. And remember, as always, we want to hear from you about ideas, feedback, because remember, this is your show. The law, your money, and you.